Now, we talked about how people create markets, create idealized commodities. One such is the coffee C futures market. I put a graph here showing the price in cents per pound for a contract of coffee. Each contract being 37,500 pounds, which is a lot of coffee. You can see that the price of coffee at Farmgate has bounced around a great deal over the years. From November 2020 to November 2021, the price doubled. From 2015 to 2020, price had been around $1 a pound. 2021, prices rose past $2, bounced down to $1.50. Since then have doubled again to more than $3 a pound. Price has been almost as high in the past, and note this is nominal dollars, but the purchasing power of $1 has declined over the decades. $1 back in 1980 was able to purchase more than 3 times more stuff. So back when coffee was nearly $3 a pound, that was a really heck of a price. But still, the recent boost in the price has been good for farmers and tougher for consumers. I just want to be clear, this is more about weather than climate. I mean, climate can have an effect, but this is really weather. Bad weather in Brazil and Vietnam, 2 of the world's largest producers, remember we mentioned that, meant that the supply curve shifted inward and the market price had to rise. Now, a big chunk of the reduction in harvest was for Robusta beans. Those are a cheaper substitute for Arabica. So as supply of Robusta falls and the price rises, that means that some people switch to Arabica, which raises demand for those beans, so the price of Arabica also rises. Some people used to save money by drinking inferior coffee, but as the price of that inferior coffee rises, they might switch over. Note our previous discussions of supply and demand, the supply curve was short run. In longer run, growers who see higher coffee prices will plant more, fertilize harder, or something like that. It takes time for the plants to grow, though, so that means the supply curve will eventually shift outward, which will lower prices. So it's not likely these high prices are going to stick around. Here's the Robusta price. It's traded in London, but still denominated in dollars. This one lists per metric ton. Metric ton is about 2,200 pounds. So more than $5,000 per metric ton works out to about $2.40 a pound. So about $1 per pound less than Arabica. But you can't go to the exchange with $5,000 and buy just 1 ton. The minimum contract is for 10 tons. Price series doesn't go as far back, but you can see that recent prices here for Robusta have been unprecedented, more than double the typical price before 2023. For the coffee C futures price of Arabica beans, I previously showed the price of the spot contract for immediate delivery, but people can also buy for delivery in the future at different dates. This chart shows the different delivery dates every few months, every other month in summer, fewer in winter, and the price of each of those contracts. You can notice the price drops as delivery goes further and further out into the future. That's pretty normal behavior. If somebody's making a commitment to buy or sell several years in the future, they can get a better deal. But especially when the price, which has historically been volatile, is at an all-time high, the lower prices definitely make sense that people are also betting the price won't stay high. For many commodities, there's a date of delivery, but often there's no actual physical good. Parties can just settle the cash value. If somebody agrees to buy it, I don't know, $5,000 a ton, and the market price at delivery date ends up being $5,200, then the person makes $200 per ton on that purchase. And they just, move the net cash back and forth. Or they do vice versa. If the price went down, then the money would go in the other direction. There's often just an exchange of funds. Some fraction of market participants will actually deliver goods, but in many cases, they just settle the value. Maybe if they're a big roaster, they've got their own shipments set up already, but they want to protect the price they pay. Or maybe there's just some gambling. speculating. Every financial market has some participants who are speculating on price changes. They think they might have an edge, or they might actually have an edge, and they use this market to make some money or lose some money. And speculation is about that. Let me divert a bit and ask a counterfactual questions. The markets I showed are for somebody willing to buy, 22,000 pounds of Robusta or 37,500 pounds of Arabica. Just to, buy one. Why might an exchange offer smaller lots? These coffee exchanges don't, but other financial markets have. Sometimes they call it a mini and offer 1/100th of the size. Why would they do that? Well, because that attracts smaller investors, gamblers, people with a smaller bankroll, also sometimes referred to as dumb money. Volatility is good for the people in the middle, the market makers. Why? Well, think about why any exchange is valuable. Suppose there's some commodity where the price never changed. Suppose it was $100 today and yesterday and last year and 10 years ago. Would anybody go to a market to lock in a price? No. Would they pay somebody a little bit of spread to buy ahead? No. There's no need. People are willing to pay for protection from price swings, if those price swings are large. If there's no swings, there's no volatility, then there's no market. When prices, on the other hand, change a lot, the people in the middle can make a large spread and do more trading. It's good for the exchange and good for the people in the middle. So why don't the exchanges do that? Well, why aren't there already mini contracts? Because the clients on either side don't really want so much volatility. Enough's enough. Having dumb money in the market can help the sophisticated traders. They can make money from separating the dumb people from their money. But it does add complications. And, the exchange isn't really offering much. People go to buy there because that's where all the sellers are. People go to sell there because that's where all the buyers are. These sort of two-sided markets are difficult to set up and vulnerable to sudden changes in basically fashion. What if there's suddenly a competitor? A lot of buyers and sellers go elsewhere. Then the market exchange loses a lot. That's a problem if somebody wants to set up their own exchange. For instance, there are places where people can create their own contracts. Some of those look more like gambling. Maybe the contract is for which team wins the World Cup or something. But it encompasses lots of other events, like whether a movie will win awards or whether a company will announce a new product. Or, somebody could offer a contract that looks like a futures contract. But if there's no buyers and sellers, nothing goes. That's the same reason why gamblers on sports games usually face a point spread. Gambling on a simple proposition, which team wins, it might have an obvious favorite. Most people would not be willing to buy and sell. So instead, the bookmakers offer a point spread. Not just will a certain team win, but will that team win by at least a certain number of points. They basically want to get it to the point where they're about equal money on each side of the bet, which is a useful way of thinking about a lot of financial prices. Those prices that we see are balancing out the trades. Many highly sophisticated traders are basically indifferent which side of the trade they're on. It's useful to remember that. If you think you got some hot tip or you watched a few videos online and you're convinced the price can only go one direction, remember, there are a lot of people on the other side of the trade, and you're not necessarily smarter than all of them. Finally, I'll note that all these prices, all these coffee futures prices, are in US dollars. People in other countries, most producers, and a lot of consumers would additionally face foreign exchange risk. They can make a contract to set up the value of coffee in dollars, but then the value of a dollar relative to, the Brazilian real would also fluctuate. So they might participate in other financial markets to lock in the price in their own currency. If the exchange ever really wanted to bring in the total degen gamblers, then They could offer mini contracts in Bitcoin or something stupid like that. All right. A few things to note about these prices. First, this is the price for delivery to a place like New York. Obviously, this is not the price the consumers pay. And I checked. Target sells 12 ounces of Starbucks Pike Place beans, which are 100% Arabica, so maybe not too far off from that contract. They sell it for $9.79, so, that grosses up to like $13 a pound. There are variations, of course. You can find it more cheaply if you search, but, the coffee C was 328 cents per pound, so that's $3.28. Now, granted, those are green, and roasting boils off some of the water in the beans, so they might lose 20% of their weight. So 20% would put the cost of the beans close to $4 a pound, once they're roasted. But still, most of the cost of buying beans at the grocery store is not the beans. And that's just if you're for a consumer buying just the beans. You buy a cup of coffee, a grande at the Bucks is around $2.50. That's 16 ounces, call it 473 milliliters, about a half liter to make it easy to do the math. Now, obviously, there are other liquids in the cup beside the coffee, including milk and whatever pumps of extra sugar / flavor. Still, if I brewed a half liter of coffee, I'd use about 30 grams of ground beans. So I could make about 15 of those size cups of coffee from a pound of beans. With beans $3 or $4 a pound, that means 20 or 25 cents of the cost goes to acquire the beans. The rest goes to all the rest. Roasting takes time and heat, so energy cost. Beans need to be delivered to the appropriate places. Shop needs to pay rent, pay the barista making the drinks. They got to pay for the milk, and sweeteners, and cups, and stirrers, and napkins, and those little cup holders so people don't burn their fingers. And then the brand name, of course, is worth a lot. They establish a brand with advertising and marketing. All of which gets to the point that coffee bean prices have skyrocketed, but how much did ordinary consumers really notice? And a separate question, how much price changes actually are passed through to the final consumer? A doubling of coffee bean prices means the cost of the main ingredient for your morning cup went up by 10 cents. That helps us get an understanding of what might be the impact of climate change on our morning routines. Adding 10 cents is not nothing, but if I drink a coffee a day, that's $36.50 per year, paying a dime more for each cup a day. It's not going to change my life. It means that coffee growers, they get a lot more. And that fundamental asymmetry there is both why climate change will not have a giant impact on most consumers in wealthy countries, and also drive some of the ideals behind ethical coffee initiatives. It's not a lot of money for consumers, but life-changing for the poor people growing the stuff. A final note, coffee prices will likely come back down. That graph I started with showed that Arabica prices in past years have gone up and come down. And now, how does that impact profits for well-known brands, say, that sell a lot of coffee? More directly, if the current price for a consumer for a pound of beans is, $13 a pound, should I compare that to the current price of beans, $3, or the price at some point in the past? The beans that were on the shelf, those were shipped some time ago. This is a common feature for many products. The raw materials were purchased at some price, then the price of those raw materials changed by the time the final good was sold. How does the company book profits? The accountants refer to the choices here as FIFO and LIFO. Yes, those are pronounced that way. FIFO is first in, first out. LIFO is last in, first out. Either the cost of the product, for us here, the beans, can be the historical price that was paid, or can be the cost as replacing the ones that were just sold. Can keep the business continuing. If I'm running a coffee shop, maybe I bought beans a while ago at $1.50 a pound. By the time I sold them, new beans were $3. So I made money. Kinda. Because assuming I want the business to continue, I have to buy more beans at a current cost of $3. If the price falls back down, then, I'll lose money in the same sort of kind of way. Firms have some choice about how to account for those fluctuations, but it's not unlimited. And of course, firms do want more money, so they want more profits. But on the other hand, they have to pay taxes on those profits, so they also want less profits. Accounting is just complicated. That's all.